Today, we're tackling a question I often receive. If I'm making $150,000 a year, David, how much house can I afford in San Diego? We'll also dive into how your credit score and debt to income ratio, known as DTI, can either open doors or hold you back. So if you're considering buying in America's finest city, stay tuned. All right, let's break it down. $150,000 annually translates to about $12,500 per month before taxes. After taxes, you're likely to bring home around $9,000 to $10,000 monthly, depending on deductions and other factors. So how much of that can you comfortably spend on a mortgage? Most lenders suggest you don't spend more than 28 to 30% of your gross monthly income on housing. For $150,000, that's roughly $3,500 to $4,000 a month for your mortgage, property taxes, insurance, and HOA fees if applicable. Your credit score is a game changer when it comes to home buying. It directly affects the interest rate on your mortgage, which can save or cost you thousands over the life of your loan. If your score is 740 or higher, you'll qualify for the lowest rates. That means you can afford a more expensive home with the same monthly budget. For example, at today's rates, you could comfortably afford a home price somewhere around $850,000 to $900,000 with a solid down payment. Let's say you have good to fair credit, 620 to 739. If you're in this range, your interest rate might be slightly higher, which reduces your buying power, but you're still in a great position to buy. Expect to find homes closer to 750 to 800,000 though. Poor credit, say below 620, it's not impossible, but you'll face higher interest rates and stricter loan terms. This could push your affordable range to around 600,000 to maybe 700,000. You may need to explore FHA or VA loan options, depending. Now let's talk about the debt to income ratio, or DTI. This is the percentage of your monthly payment that goes towards paying your debts, and it's just as important as your credit score, if not more important. What's considered debt? We're talking about student loans, car payments, credit cards, personal loans, even child support. So to ensure that you can handle a mortgage, lenders look at your total debt. What's a good DTI? Most lenders prefer your DTI to be 43% or lower. For the best rates, you should keep it under 36%. So example, let's say you make $150,000 a year and have $1,000 in monthly debt payments, like car, student loans, things like that. That's a DTI of about 8% before your mortgage. With a low DTI and good credit, you can comfortably afford a mortgage payment of around $3,500 to $4,000 a month, putting you in a range of about $800,000 to $900,000. But if you carry $3,000 in monthly debt, your DTI jumps, and you might only qualify for homes in the $600,000 to $700,000 range. So to wrap it up, with $150,000, you have many options in San Diego, but your credit score and debt to income play a huge role in your finances. Keep your credit healthy, manage your debts, and you'll be in a great position to find your dream home. If you found this helpful, remember to like and subscribe. Hit that bell for more tips and navigating the San Diego real estate market. If you have any questions or want personalized advice, comment below or reach out directly. We're always here to help. And before you buy your next home, watch this video.